Welcome back. It's Mike and it's Max, and today we're talking dividend-focused ETFs.
Yeah, we are.
Welcome back. It's Mike and Max, and in this video we are talking dividend-focused ETFs.
Not all dividend funds are created equal, and that's why we have a variety of different ETFs for you today.
Depending on where you are in life and what role you want dividends to play in your portfolio, we've got some ETF options for you.
My life is good. Really good.
Whether you're looking to fund retirement or simply want to
maximize your gains,
ETFs are an excellent alternative to picking individual stocks to diversify your portfolio.
Fantastic.
And there's no need to pay a suit to pick stocks when you can easily do it from your phone.
Wait.
As with all of our vids, this is not financial advice. We just like to pass on some info that we found helpful when managing our own finances. If you find any of it useful, give us a like and leave us a comment.
Let's dive right in with the Invesco Preferred ETF, ticker symbol PGX, which is a fund that follows a preferred security index. Preferred shares are when shareholders get priority on dividend payments, usually at the cost of voting rights.
They're usually first in line to receive profits when they're being paid out. PGX fits this category perfectly as they prioritize consistent and high dividend yields.
The fund only has a 2.93% return year to date, but is enjoying a healthy yield of 4.49%.
It's also carrying a 3-year return of 7.3%, which isn't half bad. It's holding 296 positions in fixed rate securities and manages over $7 billion in assets.
The expense ratio is middle of the road at 0.52%, and the fund is rebalanced monthly. One of the things that we like about this ETF is that it uses a credit scoring screening system on all potential holdings.
This boosts yields and reduces volatility at the cost of some growth. The fund has a financial sector weighting of over 65%, but enjoys moderate diversity otherwise, with a market cap under 2% per allocation.
You're probably familiar with some of the big names in the top holdings like JP Morgan, Citigroup, and Wells Fargo. We recommend this ETF if you're looking for a higher yield income producing fund.
Staying on the high yield trend, the next on our list is the large cap value fund WisdomTree's US High Dividend Fund, ticker DHS. As the name mentions, this fund is comprised completely of US equities with an excellent dividend yield track record.
Add this to their exclusion of sub 200 million market cap companies and minimal holdings in the tech and healthcare sectors, and you've got yourself a consistent dividend income paying ETF.
The current yield is 3.79%, and as a bonus, the fund has a year-to-date return of over 13%. Since inception in 2006, it's also been able to return over 6% year over year.
The fund's 315 holdings are rebalanced yearly, and some of the top companies include AT&T, Verizon, and Coca-Cola. We like this ETF as a higher dividend yielding fund with moderate growth from all American investments.
America.
A couple of popular ETFs similar to DHS are Vanguard's High Dividend Yield ETF, ticker VYM, and Schwab's US Dividend Equity ETF, ticker SCHD. Both of these funds are high dividend, low cost options with great track records that are also worth a look.
Next on our list is the iShares Core S&P US Value ETF, ticker IUSV. Classed as a total market value fund, it draws its holdings from the S&P Top 900 list of large and mid-cap stocks.
The expense ratio on it couldn't be much lower than the 0.04% they charge, and considering they rebalance quarterly, this is extremely good value for the price.
The dividend yield is just over 2%, which isn't as high as others on our list, but the fund is making a 17.5% return year to date and over 12% average over the last 3 years.
It also has a broad reach on the US market with 732 holdings, which gives you plenty of diversity and low volatility.
This ETF is solid, not only because of its extremely low expense ratio, but also because of its broad reach on the large and mid-cap market. Aside from a rough 2020, it's shown great growth with consistent dividends.
Let's talk about the big dog for a minute, Vanguard's Dividend Appreciation ETF, ticker VIG. With a massive $76.6 billion in assets and a rock-bottom expense ratio of 0.06%, it's no wonder why this is one of the most popular ETFs out there.
VIG tracks the NASDAQ US Dividend Achievers Select Index. The fund's 250 holdings aren't sexy, and its yield isn't anything to brag about at 1.79%. but where it does excel is in its stability.
VIG holdings require 10 years of increased dividends, as well as being put through Vanguard's profitability screener. The result is a low-risk, low-cost fund with huge market cap dividend stocks.
Year to date, it's holding a 10.5% return and a 17% return over the last 3 years. Classified as a large cap blend of the biggest equities in their class, you've likely heard of most of their holdings like Microsoft, Walmart, and Visa.
We recommend VIG, as do many others, when it comes to a solid option for a very affordable, low-risk dividend fund that holds well-established companies.
Moving on, if you have enough US large cap exposure in your portfolio and you're looking to broaden your horizons, look no further than iShares Emerging Markets Dividend ETF, ticker DVYE.
This fund tracks the Dow Jones Emerging Markets Select Dividend Index for high dividend paying options. 94 of the top dividend performing holdings are some of the biggest and most proven securities outside the US.
The sector weightings are heavily into energy, financials, and utilities with very little growth companies that would hurt yield. It also holds over $880 million in net assets and a moderate expense ratio of 0.049.
This ETF is proving that international stocks can be a great option. Not only is the dividend payout appealing with a current yield of 6.56%, but the year-to-date return is over 13%. This ETF is a great addition that won't overlap your large cap aristocrat dividend funds.
No, come on, don't be crazy.
Moving on, real estate investments can give you competitive returns thanks to long-term appreciation and steady dividend income.
Not only that, they provide portfolio diversification and likely won't duplicate your other dividend investments, which can reduce a lot of volatility risk.
If this sounds like something you're interested in, our last ETF is one you should check out. The iShares Mortgage Real Estate ETF, ticker REM. This tracks an index composed of US REITs that hold commercial and residential mortgages.
This gives investors exposure to the real estate market without having to deal with all the hassles of owning and maintaining properties themselves. The fund manages over $1.5 billion in assets and has a respectable expense ratio of 0.48%.
REM distributes dividends quarterly, and this year they're sporting a generous yield of 5.59%. Additionally, they have a year-to-date return of 21.7% thanks to the US real estate market being on fire.
Though the fund only has 33 holdings, the mortgage and diversified REITs within it hold mortgages from coast to coast. We recommend this ETF not only for its ability to diversify your dividend portfolio, but also because the real estate market continues to be a huge part of what drives the US economy.
Whether you're after dividend or high growth ETFs like in our video up here,
Like right up here?
we always recommend doing your own research to find ETFs that match your investment goals.
With that said, let us know if you like any of our dividend ETF recommendations in the comments below, and don't forget to subscribe.
And turn on post notifications so you don't miss any of our upcoming videos. I'm Mike.
And of course, I'm Max.
And we'll see you guys next week.
See you next week.